Welcome to PhillipCapital Weekly Market Watch. My name is Lin Sin from Unit Trust Research. In this week's commentary, we will look into the recent significant US events which has impacted global equities and what to expect in the near future. The US Federal Reserve surprised market participants and Treasury yield observers when it decided to maintain the $85 billion monthly asset purchases after the latest FOMC meeting in September. Stocks and bond markets rallied on the news. Nevertheless, forward guidance on interest rates has been released during the meeting. That is, monetary policy to remain highly accommodative until the economy recovery strengthens and the unemployment rate moves at least to below 6.5%. However, uncertainties is again cast upon the markets, as the Fed officials hinted after the meeting that an early scale back as soon as end of this year is still very much intact. Within a week, the Fed gave contrasting signals to the public. The Fed decided to keep its schedule in suspense and leave it to the market to debate on when and how it will cut back on the stimulus package. Without greater transparency in the Fed policy deliberations, markets are expected to whipsaw while investors continue to hold their breath and prick up their ears to each and every economic indicators whenever the next FOMC meeting looms. The stock rally after the meeting was snapped by the standoff between President Barack Obama and the Republicans, which subsequently forced the US government to begin a partial shutdown on October 1st, its first time in 17 years. Some of the government services and operations are impacted until Congress passes a budget to fund them again, such as permits and reviews for planned energy and transportation projects will stop, preventing companies from working on these projects. Loans to rural communities will be held. Hundreds of thousands of federal employees will be put on unpaid leave, while federal offices, national parks, monuments, and museums across the country will be closed. Since the tapering talk, investors have been trading with job reports. Due to the government shutdown, the Bureau of Labor Statistics will not be publishing the official job reports this week. Market participants have hence turned to ADPs as alternative. ADP's report estimated a weaker than expected job creation in September. 166,000 private sector payrolls were created versus an expectation of 180,000. Versus August 176,000 reading was revised down to 159,000. Stocks and the greenback dropped, while bond and gold surged on the back of government shutdown moves and weak ADP job reports. Despite that the Republicans are holding out for concessions on the healthcare law, the Affordable Care Act, in exchange for a budget vote. However, against the backdrop that 1. Congress must raise the debt limit in coming weeks or risk a default that could roil global markets. And 2. Fighting over the debt ceiling has historically been proven to be a popularity-losing effort. Hence, it seems unlikely that the world's largest economy will nip the nascent economic recovery in the bud. Therefore, we expect that the debt ceiling to be lifted on time and have not much impact in the near term. Having said that, in any event, tapering is inevitable. Tapering is not an immediate one-off process. It is likely to take place over an extended period of time, and market participants will have ample of time to adjust. Once the Fed begins to curtail its monthly stimulus, the markets may begin to perform more in line with economic fundamentals. Hence, it is advisable to base your portfolio around longer run trends, and investors with a bottom-up investment philosophy are expected to be rewarded amid these notable shifts in stocks and bonds. If economic growth picks up at the pace that the Fed expects, then the yield curve will continue to widen with 10-year Treasury yield to steepen and overnight rates to remain low till end of 2015. The overnight rate will slowly catch up as US economy stabilize and eventually lead to an upward shift of the yield curve. Although bond market may gain at the current environment, but it will not revert to the previous swooping return. Investors may wish to position their fixed income portfolios such that they are less susceptible to gradual interest rate hike. In addition, Lawrence Summers, whom has been perceived as a hawk by the markets, have pulled out from the Fed chairman race. His withdrawal boosted the markets, especially the emerging market assets. Although emerging markets may grow at a slower pace than previous years, but they are still expected to grow at a relatively higher rate compared to the developed markets. Hot money was flowing out from the EM as markets jittered over the news of QE tapering since June. Then again, bearing in mind that although the gradual QE tapering may mop up some of the liquidity from the system, but the Eurozone, UK, as well as Japan are also injecting plenty of liquidity into the system, spurring and supporting growth of risky assets. Risky assets, such as equities and high-yielding bonds, are deemed to remain attractive versus the government bonds. Thank you for watching this week's market commentary. We will see you next week.